Ladies and gentlemen, welcome to Accounting 1, where today we'll be looking at ratios, the analysis and interpretation of financial statements. You do remember our definition of accounting. Accounting is the systematic recording of financial transactions in the books of accounts, the preparation of financial statements, and the interpretation of those financial statements. So in this discussion, our focus is on the financial statements, how we look at the financial statements, and when we look at the financial statements, what do we make out of them? In other words, how do we read and interpret the financial statements? What do we mean by financial statements? We just mean the financial reports that we are quite familiar with. We're looking at the balance sheet or the statement of financial position. We are looking at the income statement. We are looking at the cash flow statement. And at times we may look at the statement of retained earnings. So that's what we mean. So we are going to be focusing on the ratios, using ratios in order to analyze financial statements. And one reason why we do financial statements analysis, it's because our duty as accountants or financial managers at some point require us to assess our organization's performance, that is the present performance, the past performance, and to project the future performance. It also enables us to analyze our strengths and weaknesses as an organization. How well are we doing? And this can be measured or can be read from the financial statements that are presented or that are prepared for the company. So the primary tools, like I've said, is the financial ratios that we'll be employing and the statements that we use, the balance sheet, the income statement, you name it. Now, those are our financial statements, the four listed there, and the objective of ratio analysis and financial statement reading is for us to be able to compare figures or evaluate the performance based on percentages or proportions or changes expressed in percentage terms. This will enable us to know whether our performance this year is better than 2 years back, is better than last year, and so forth. So it's all about comparing performance so that we know how well we are doing and where we stand. Those are the objectives of ratio analysis, to see the risks we are we find ourselves in, the efficiency of our activities, and to compare. Now, let us look at the types of ratio analysis or tools that we use in ratio analysis. We have got what we call liquidity ratios, which seek to measure the firm's ability to meet its current and long-term financial obligations. An organization does incur expenses, and now and again it will need to make sure that it is well positioned, or it is in liquidity, healthy position to be able to meet those financial obligations. Then we've got what we call asset management ratios, or investment, we can call them as well shareholder ratios, which essentially seek to measure the risks associated with the business in as far as the earning potential of the business is concerned. We're looking at assets employed, and we're saying how much are these assets earning for the organization. Then the third ratio that we shall be looking at is a gearing ratio. Gearing ratio simply focuses on the mix that is between the debt, our structure, debt and equity. How much did we finance our business from borrowed funds, and how much did we finance our business from funds that were injected or that are the owner's funds? That's basically that we be looking at there. Then we have got profitability here, where we'll be focusing on how profitable the business is doing. And we finally look at financial ratio. Here we'll be looking at the rate at which the company sells its stock, the turnover ratios, you name it, and the efficiency associated with the usage of the assets when compared to those assets. Well, we have mentioned the financial statements. We talked of the balance sheet. We've got the income statement or the profit and loss, and we've got the balance sheet and the profit and loss combined. So what I've done here on the slide that you can see, I've got the first column where I say the balance sheet ratio. These are ratios that in order for us to calculate them, we have to be looking at our balance sheet. For where we've got the current ratio is where we are focusing only on the current sections of our balance sheet. A balance sheet has got two current sections, that is the current assets section and the current liabilities section. So in order for us to calculate those, we will need the balance sheet, and we calculate those two. Then we've got the proprietary ratio and the debt equity ratio. In order to calculate those 1, 2, 3, 4 ratios I listed in that column, we need to have a balance sheet. And this balance sheet should not be for 1 year, it should be for 1, 2, 3 years and so forth, so that we are able to compare. That's the idea. Then from the income statement, we've got certain ratios that require us to be looking at the income statement or the profit and loss or revenue statement. We call them revenue statement ratios. And here we're looking at the gross profit ratio, the operating ratio, the expense ratio, the net profit ratio, and the stock turnover ratio. You would find all these require variables that you will find on the income statement. Then the last column to our right, we have got the balance sheet and income statement combined. There are certain ratios that require us to be looking at both the income statement and the balance sheet for us to be able to calculate. We have got the fixed asset turnover ratio, return on total resources ratio, or return on total assets ratio. We've got the return on funds ratio and earning per share ratio. Then we've got the debtors turnover ratio. We will not be looking at all these ratios. We will look at those that we are supposed to know according to our course outline. Well, let us begin by looking at the current ratio. Well, before we get to that, let me warn you that I will give you a set of these records that we'll be looking at: the statements, the income statement, the balance sheet, you name it. But first things first, let's look at the current ratio and we see what it seeks to measure. The current ratio, it wants us to focus on two sections of the balance sheet: the current asset section and the current liabilities section. And the formula or the ratio itself, it's simply current assets is to current liabilities. Wait, what does that mean? Ratios, it's just like we are saying current assets divided by what? Current liabilities. It's another way of expressing a ratio. And we're saying the ideal ratio of that we require when we're looking at current ratio is that one of 1.5 to 1. But this is not cast in stone. It will depend on the industry. Some industries require that we have got a lot of cash and cash equivalents at our disposal, so that we can quickly liquidate those current assets into cash and on our financial obligations. So it's dependent on the industry. Well, but ideally, a 1.5 to 1 ratio is good. A ratio of 5 to 1 would mean the firm has $5 of assets to cover every $1 in liabilities. Okay, if you're having $5 to cover $1 of what we owe, good, it seems, but is it good? We'll see as we go on. A ratio of 0.75 to 1 suggests that the firm only has got 75 cents in order to cover $1. That can be good. If we've got 75 cents to cover every $1, What happens if the $1 falls due? We are supposed to pay the $1 and we only got 75 cents. That it becomes a problem. So that is not a healthy situation. But it's not necessarily that when we've got a bigger ratio, current ratio like that 105:1, then we say it's good. Too high a ratio, if the current ratio is too high, it might mean that we have got a lot of cash and cash equivalents tied up in unproductive activities of the organization. We have got more money than we need. It's not good to have more money than we need, because in accounting, we try to maximize value. So the excess money should be invested where it will earn a return that will benefit, that will bring value to the organization. And too low a current ratio, you have seen with the example of 0.75:1, that it's bad. It means we cannot pay our dues in the near run. Well, then we've got what we call the acid test or a quick ratio. The acid test or a quick ratio, it's a more refined current ratio. What we've done is, in our current ratio, where we say the current asset divided by current liabilities, we looked at all the current assets, including inventory stock. But in the acid test, we are saying sometimes current stock, it will take us quite some time for us to go and liquidate it. What do we mean by liquidating? It means converting the inventory into cash that we need, because we need cash in order to pay our liabilities. We don't need inventory to pay our liabilities. Inventory will take us time to convert to cash. So we are trying to do an acid test, right? A critical test to say, if we look at our current assets and we remove the stock, that will leave us with things, with current assets that are mostly cash. And it is cash that we need to pay the current liabilities. So when we do that, we are saying current assets minus stock is to current liabilities, or current assets minus stock divided by current liabilities. And the ideal acid test ratio is 1:1. So a ratio of 3:1 suggests that the firm has 3 times as much cash as it owes. Very healthy. It means for every dollar that we are expected to pay within the current span or current time period of the organization, and the current time period, it's within the next 12 months. It means we have got $3 reserved to pay $1. So we can sleep well and know that anything that falls due will be able to pay, because we are well covered. A ratio of 0.5:1 suggests the firm has twice as many liabilities as it has cash to pay for those liabilities. That is bad, because what does that mean? It means for every dollar that we are expected to pay within the next 12 months from now, beginning today, the next 12 months, it means we only have got 50 cents. So when the dollar falls due, we cannot be able to pay it, which is bad. Now, I want us to look at the financial statement that we have, okay? That is the income statement. We'll be looking at the income statement because this is where we'll be getting some figures when we are doing our calculations. And to avoid a situation where we'll be moving forward and backwards, I've got hard copies that I have here that I'll be showing you when we're doing our calculations, so that we refer to them to see which numbers we are looking at before we move on. That is the income statement. And we also have got the balance sheet. Those are the figures. Don't worry about the figures now. We shall come back to them when we need them during the time of the calculations. And we've got the balance sheet, liabilities and equities section. Don't worry about it as well. We shall come to it. You might see there on the numbers, I have put 2016, the middle column, and 2017E, right? My assumption here is we are in 2016, right? We are in 2017, but we've not come to the end of 2017. So we don't know really at the end of year, come December 2017, where we will be standing. So those are estimated. The E stands for estimated figures. We have just projected them. Well, The other data relates to stock price, number of shares, earnings per share, you name it. So we'll be looking at those figures as well as we go on. Well, now, I want us to go to the current ratio. Okay? The current ratio, like I've said, we'll need to look at the current section of our balance sheet. Okay. Now, I will need us to look at the balance sheet. This is where I said we'll be moving to and fro. I'm not sure whether you can see properly. Let me try to adjust the figures a bit. Right. I hope you'll be able to see. Right. Now, CR10 there simply stands for our current ratio. Current ratio. Now, in order for us to calculate this current ratio, there is something that we need to do. Okay. I'm looking first here. Sorry. On the slide there, let's read the caption. Let us forecast the current and the quick ratios. Look at our balance sheet. Wrong grammar there. For 2017. It's supposed to read 2017 as indicated here. So my apologies for that omission and for that grammatical error. Well, we have said current ratio is current assets to current liabilities. Like you can see, the CA stands for current assets, the CL stands for current liabilities. If you go to this column, let me highlight this column. Okay? Our total current assets, if you look this column, this row, right? This is 2016. We're concerned here with the figures of 2017 estimate figures. The 2,680 there, it's coming from here. I hope you can see it. It's representing thousands, which is 2,680,112. The other dollars, we can leave them out because, like we know, we use the concept of materiality. They're immaterial. They will not affect the decision making in the organization. So those are the figures. We are taking them from the current section of our balance sheet. So we take it, we've got the figure of our current assets. Now, we need our current liabilities. We don't have our current liabilities here. I'll need to go to the figure for our current liabilities. Right? This is the other part. We go again to 2017. You look at the total figure for our current liabilities figure. And we go to 2017. You see that figure. It's 1 million here, 1,039,800. What I've done, I've rounded everything up to the nearest thousand. Therefore, it becomes 1,040,000. Now, the 03 zeros, I'm just leaving them out because they will not make a difference. The answer remains the same. I just took them off since it's a division. So if we divide that, we will get a figure, a ratio of 2.58. Now, remember this is a ratio. A ratio of 2.5, we can write it as follows as well. 2.5, it's simply the same as, it means 2.58 is to, as a ratio, is to 1. That's what it means. It means a ratio of 2.58. It could have been 3, it could have been 2 is to 1. This time around, it's 2.58 is to 1. Okay? But we can simply write it as 2.58. Now, having done that, I want us to see what that means. Okay? Okay, before we get to that, let's see what we get from the quick ratio or acid test ratio. That's the other ratio that we said we'll look at. This time around, we're going to be using the same documents that we used: current assets minus inventories divided by current liabilities. Right? As you can see from the above formula, our current assets figure will not change, 2.680. Our current liabilities figure will not change, 1.40. We just need to bring in now the inventories figure. From the sheet here that I have, this paper, our inventories, it's this figure that I've highlighted, 1,716,480,000, okay, which we are going to just record there is 1.716. Okay, let's do that and see what we come up with. Okay, so that's what we've done there. If you look, we've said it's 2,680 minus 1,762. Okay, let me bring that page to our the hard copy. So what we have just done, we have brought in the inventory, the figure that I have said it's coming from our balance sheet. Remember, here we're taking the figure from here. This is the figure that you find here. So we divide that, and what do we get? We get a 0.93. If you remember what we said earlier on, we said an ideal situation is where we have got a current ratio of 1.5 to 1. In other words, a current ratio of 1.5. And we said, though, it would depend on the industry. So when you look at our ratio there, it's 2.58, which is above the ideal 1.5. Okay, we'll analyze shortly and see whether this is a good position or not. Okay, now we said as well, when it comes to quick ratio, we need a ratio that is 1:1. Oh my God, here we've got 0.93. 0.93, it's below the 1.1. Because 0.93, like we've said, is the same as 0.93 is to 1. Yet we need a ratio of 1:1 is the ideal one. Okay? Let's compare these figures. Now, if you look at those figures, what I've done, the CRI is standing for the current ratio, the QRI is standing for the quick ratio, and let's have them here. Okay, those are the figures that we're looking at. We would now like, because the whole idea of us analyzing our financial statements is for us to be able to make decisions or interpret what it means for the organization so that corrective action can be taken. Okay, the IND here stands for industry. Those are industry figures. When we are comparing our performance, we compare ourselves with what others are doing, or we compare ourselves to what others are doing. Now, here are the figures that I've given. Some of them, don't worry where I took them. I calculated them the same way we are calculating them. So you will be given those figures in an examination situation or in your assignments, and you'll be required to calculate the last one. The industry figure in this case is 2.7. That's the current ratio figure. In 2015, our current ratio was 2.7, which was below the industry average. Remember, I said it depends on the average. Earlier on, we said the ideal one is 1.5:1. But this industry in which we are, it means the ideal one is what? The average is the ideal one, 2.7. So if we are 2.7 or slightly 2.7, we'll be better off. So 2.7, in 2015, we were below industry average, which is not a healthy situation. In 2016, our situation worsened. We went down to 1.46 compared to the industry average of 2.7. In 2017, the one that we just calculated, remember, we got 2.58. So it's a bit better because our target should be to be somewhere closer to the industry average current ratio. Okay. Then when you look at quick ratio, the quick ratio, the industry one, is what? 1, which is 1:1, which is good, the ideal one. Let's look at our situation. In 2015, we were 0.8:1, below industry average. So it means we only had 80 cents for every dollar that needed to be paid in the short run, that is within the 12 months. In 2016, our situation worsened. It means we only had 50 cents to pay every dollar that we owe the outsiders within the next 12 months, which is a bad. So our situation here was getting bad. Okay? In 2017, we expect to have improved to 0.93. Because our target should be 1, we should have 1 here to match with the industry. But in this case, although we've improved from here, but like you can see, in 2015 we were on 0.8, we went down. I don't know, perhaps in 2018 we'll go down again, fluctuating like that. But it means there is something wrong. Now, what are our comments there? Right? We expect it to improve, yes, to 0.93, which is better. But still, our liquidity position is weak. Right? Our liquidity position is weak. It means we need to improve our liquidity. Some might say, but how do we increase our liquidity position? Okay, let me go back to the right, and give you hints on how we can improve ourselves. Right. When you look at these figures, the calculation, okay, the current ratio of 2.58, we said the industry is what? 2.7. To go there are two things that can happen here. The current liabilities, either the denominator should be smaller. By reducing the denominator, it means it has got a bearing on current liabilities. It means we must try to avoid what? Current liabilities. That is, instead of buying on what? On a credit, let's reduce. Those are current liabilities. Okay, that's one. Let's look at current what? Current also. Let's look at current assets. The current assets that we can see there, it's 2680. The other way of increasing our sales from 2.58 to 2.7 is to increase the numerator here. How do we do so? Which means our focus should be on the current asset section of the balance sheet. And what items do we find in that section? We find trade or accounts receivables. It means we can increase accounts receivables and also increase the numerator there. How do we do that? Right? Accounts receivables can be increased by increasing or relaxing our terms of sale. What does that mean? Either we should be aggressive or sell more on a credit so that the accounts receivable figures goes up. When it goes up, the numerator will go up. And when the numerator goes up, let's say to 3,200 or 3,500, then our ratio will also go up to match. So this ratio enables us, or it's telling us the actions that we must do. By going to our balance sheet, it's telling the management what action must be taken to address the situation so that we operate from a healthy liquidity position. Similarly, if you look at the quick ratio, we can do the same. Either there are variables that we may play around here. Inventory. It's either we don't need to keep a lot of inventories. If we reduce our inventory stock, it means we will have a smaller number to subtract. Instead of 1,716 here, perhaps we only need 1,000 here. what happens? If that happens, it means our numerator will be bigger, and if it is bigger and other factors held constant or other variables not changed, it means the numerator has gone up, and it will also push our acid test ratio up to 1 where we deserve. So the good thing about ratio analysis is that it tells management the areas of weakness and what strategies that must be put in place. Either reduce your inventory stock. You are keeping a lot of money, tying a lot of money in your inventories, right? What do we do? Make sure that you have got an aggressive marketing department or selling department that reduces those inventories, and make sure that the purchasing department doesn't keep a lot of inventories in stock. So in other words, we must go the JIT route, just in time. Buy little, keep little, so that we don't have these big figures. We don't tie our money. We release our money from the stock held. That's all we mean there. Now, we have done the comparison already there. Okay. I want us now to look at the asset management ratios. The asset management ratios. The asset management ratios simply focus on the assets that we have employed or invested. And we are saying these assets, how much money are they generating? We may have a bus, it's our asset in our business, but sometimes we are waking up very late in the morning to go and ferry our passengers. What happens at the end of the day? The revenue the asset brings to the organization will be limited. But if it has got these frequent trips, this asset is generating more and more revenue, then we are utilizing the bus efficiently. That is just an example. Okay. Let's look at one of those. We've got what we call inventory turnover. What do we mean by inventory turnover? We are simply saying we look at our sales. How much sales, like in the example of the bus, how much revenue are we generating, right? Compared to the inventory of stock. So in other words, we must make sure that we don't keep the inventory for long in our organization. We must quickly get rid of it, sell and bring some, sell and bring some. So if we are selling more and more, we won't have a lot of what? Of inventory in stock. But our sales will go up. So the lesser the inventory and the more the sales, it means we are efficient from the little inventory. We are turning it fast and fast and fast. So inventory turnover is the number of spinning, we call it spinning, spinning the money. The inventory that we have, the stock, how much are we spinning it in order to make profit out of it? Now, let me take the same slide that you can see there so that we discuss that one. Okay, there we are. Let me bring this one here and put these ones there. Okay. Okay, there we are. I hope you can see that one. Right, what do we mean? Sales, inventories. Still, the sales, where do we get sales from our financial statements? You need to go to your income statement, remember? But inventories, do we find inventories on the income statement? No, we need to go to our balance sheet current asset section. Where is my balance sheet current section? Okay, there it is. Okay, right? The formula required there is sales divided by inventories. And sales, we get them from the income statement. Right, where are you, income statement? There we are. That is our income statement. Let me push it down, okay? Okay, for 2017, remember we're focusing on 2017. Sales figure, there we are. 7,035,600. That's our sales figure, right? I've rounded it up to the nearest 1,000 and divided by 1,000. Okay? I want to work with smaller figures. The thousands will not change. Okay? So that's where we are getting that 7,036 that we are seeing replacing in the place of sales. our inventories, don't forget, we go back to our balance sheet section. Okay, this is our inventories figure, the denominator that you can see there. Work that one out and you get a figure of 4.10. That is our inventory turnover ratio. Now let's compare it with the average industry. Okay, industry average, compare it with our industry average. Okay, now if you look at that one, okay, there we are again. Right, we have got the industry average of 6.1. Okay, we have got 4.8 there in 2015. We have got 4.5 in 2016. We're going down. We have got 4.1. It's worsening. That is our projection. My God, we are running away from the 6.1. So our graph, instead of going up, because the objective here is we must be at par or somewhere closer to industry average. So other players in the industry, they are spinning their inventory faster than we are doing. We are operating sluggishly. So it means here we are sleeping on duty. We are not doing well. What does that mean? When you look at that, it tells volumes to the management to say something is wrong either with our selling department. We need to energize that one, revamp it, because that's where we are lacking. Well, let's have some comments. We are saying our inventory turnover is below our industry average. So what does that mean? Perhaps the firm has got some old inventory that it is keeping, and that is what is making our inventory figure, that is the denominator there, big. Let's go and look. Perhaps we need to get rid of this. Perhaps we are buying more and keeping more than we need in the storeroom. We need to look at those so that we reduce our figure here. We need to reduce our denominator. When we reduce it, obviously, this ratio will go up. And when it goes up, it will go towards 6.1. That is the average. That's precisely what we need. So we need to revisit our control of inventory and our purchasing policy, right? Sometimes we use the economic order quantity. Remember that one? Where we try to buy the quantities that will make sure that we don't lose revenue by stock outs. People want to buy our product, then we have run out of stock. But we should have stock that we need to use in the short run. An abstract example, let's say you run a restaurant and you cook too much food than you need. What do you do with the leftovers? You have got unnecessary inventory. Some of it will be lost through pilferage, people stealing. Some of it will go bad if we are talking of perishables. So all these things are what we are focusing on. We need to be in the same range or region as the industry average. Right. So there is no improvement when you analyze our performance from 2015 to the projection of 2017. We are worsening. We need to get it right. Okay. Then the other ratio that I will be looking at today is days sales outstanding. What do we mean? Days sales outstanding. You know, from the time we make a sale, it means people owe us money. That is if we have sold on credit. So for how long? How many days are we going to wait until we receive the money? This is the period that we are talking about. Days sales out. We have made a sale, but that sale is still outstanding because we have not received the money. And the longer the period is, it means people are having our money for long. And we are doing without that money. So the shorter the period, the better. If we sell today, we get money tomorrow, then it means we have got our cash and we can control, invest it. But if we spend 30, 40, 50 days without receiving the money, we'll be broke. Okay, let's look at the formula. Okay, right. The formula for DSO, days sales outstanding, it's receivables divided by average sales per day. Right. So we need to know our receivables. Where do we get the receivables? From our financial statements, of course. But which one? Receivables, we get them from the balance sheet section. Okay? Then how do we get the average sales per year? We don't have that figure anyway. But here's the trick. If you go to our income statement, we've got the sales figure. We know in a year we've got how many days? 365. So if we divide that sales figure in the income statement, because those sales are the sales for the entire year, if we divide that figure by 365, we'll be able to get the average sales per day. Then the receivables figure, like we have said, we go to our balance sheet. Now, let's go back to our income statement. Where is our income statement? Okay, I see here the balance sheet. Okay, income statement, here you are. This is our income statement. Okay. We've got our sales here, 7,035,000. Remember, we rounded it up to the nearest thousand, and we ended up with 7,040,000. Okay, so we've got that figure, we have got it. Okay, receivables divided by what? Average sales. Sales, we are going to divide that one by 65. That's what you can see on that slide. Okay, let me put it here. All right. The sales, we said it's 7,036,000, right? So we are dividing by 365 days. Remember, these figures are in millions. So 365 days in order to get the average per what? Per day. Now, receivables. I said the receivables, we'll get them from what? From our balance sheet. Let me take you back to the balance sheet. Receivables, accounts receivables. Right. If you look at this figure, you find our accounts receivables. Right, where are our account receivables? It's this AR. Okay. And 2017, it's 878,000. Okay? That is where we are getting that 878. Okay, thousand divided by what? 7.036 divided by 36, and we get 45.5 days. So what does that mean? It means from the day we make a sale, okay, we invoice somebody because the sale has been made. We have earned that revenue, but we have not received it. We have to wait for 45.5 days until we receive the cash. Okay. Now, let's analyze. What does that mean? You see the industry average, it's 32 days. My God, 32 days is the average. And our average here is 45.5. We are above average. We are too slow to collect money. Whereas all the other players in the industry are selling and collecting their cash within approximately a month. It's taking us beyond a month to collect what belongs to us. So that has got a serious negative impact on our cash position. We are not collecting the money, but we are taking too long. So it means we also have financial liquidity problems. Okay. The firm is collecting too slowly, and the situation is getting worse because in 2015 we were at 37.4. Now, in 2016, we went up to 39.5. Now we have even gone, we are projecting 45.5. So we are relaxing. We need to revisit our credit policy because it's poor, we need to revamp. If it's an organization, you need to make sure that you read the Riot Act to the people who are in your selling and marketing department, because they are sleeping on duty. Okay. Now, I want us to look at the fixed asset turnover ratio. Okay? Fixed asset turnover ratio. What do we mean by fixed asset turnover ratio? We are simply saying, when we look at the net value of our fixed assets, okay, how much are they generating? Okay, each one of them, how many times, if we look at the value, that amount that we invested is the one that is spinning to generate the sales. So the net of our fixed assets, how much time? So we look at the value of the net fixed assets and we look at the sales. So it gives us a rough idea of the number of times it's selling 1, 2, 3, 4, 5 times. In this case, you find that it's selling or generating, it's about 8.41 times. So the idea is to just know where we get the figures. Net fixed assets 837. Where do you get the net fixed assets? You get them from the balance sheet asset section of our balance sheet. That's where we get those figures. Right, let me see. This is the current assets. Right. Okay, when you look at our balance sheet, okay, you see our net fixed assets figure for 2017 is this figure, 836,840. Rounded up to the nearest thousand, that's 837. Right. Divided by 3, it's $837 that you see there. It represents 837,000. And our sales figure, we know already, we get it from the income statement. Then we divide, you get that. Okay, so 8.41. Looked at it per se, it doesn't mean anything, that ratio. It will make sense when you are comparing it with the industry and the other years you have been in the business. So let's look at the other asset ratio as well, the total assets turnover ratio. Right. Remember, in the fixed assets turnover ratio, we are looking at the net of fixed assets. But in the total assets turnover, you are looking at the net of fixed assets plus the current what? Assets. All those are our assets. That makes the total asset figure. When you look at this balance sheet section, this is the net fixed asset. But when we add the net fixed assets here to the current assets, it will give us the total assets. So this is the figure that we'll be using in our calculation of the total assets turnover. The sales figure, we already know it will not change. It remains 7.036, but our denominator now becomes 3.517 when rounded up. Okay, so that is how we will get that one. The total assets figure, 3.5, this figure, rounded up to the nearest 1,000, which gives us 3.517 as the denominator, and our numerator being 7.1. Let's see what we'll get. It's 2. Okay. Again, that ratio won't make sense unless you are comparing it with the industry average, and unless you are comparing it with your past year's performance. Okay, now let's see what that simply means. Okay, there we are. It would mean that, let me take it here. The industry average, when you are looking at the fixed assets ratio, fixed assets turnover ratio, the industry is 7. You can see it here. Its industry is 7. Okay. Ours is 10 in 2015. In 2016, it's 6.2. It was 6.2. This year is projected to be 8.4, right? We say the fixed assets turnover ratio. We're looking at our net fixed assets and saying how many times are they spinning, making money? The industry average is 7, but in 2015 we were above average, which means the wheel was turning faster in our organization in as far as the assets, our net worth of assets is concerned. They are generating more money. In 2016 we were below the average. The wheel was turning slowly. And in 2017, it's now getting faster and faster to above average, which is good. That's what it should be. When it comes to fixed assets turnover, it must be faster. Okay, so what comments can we make there? Fixed asset turnover expected to exceed industry average by the end of 2017 because we project it to get to 8.4, whereas our average is at 7. So we are not doing bad there. It's good. When you look at our total assets turnover ratio, the industry is 2.5. Okay. The ratio of our total assets in 2015 was 2.3. In 2016, it was 2. In 2017, it is projected to remain at 2, compared to the industry 2.5. So we are below, right? What is the implication? It is like we said earlier on. This may be because we are keeping a lot of assets, inventory in the organization that is unproductive. You buy inventory, you keep it there until perhaps it perishes, right? If you are dealing with the perishables, or there's pilferage. Some people will be picking 1 or 2 until there is nothing. So it's not being productive, it's not generating, it's not spending money. That is why we earlier on said we need to revisit our inventory policy and strategy. Now, let's look at debt management ratios. Okay? We'll make the debt management ratios our last ratio. Okay. What do we mean by debt management ratios? We are simply saying, okay, how much, we're trying to measure, how much are we deep into debt, right? Out of our assets, what is ours? What is not ours? That's the ratio. We are saying, comparing what is not ours to what is ours. Total liabilities divided by total assets. Where do we get this? We get this again from our balance sheet. The liabilities section and the assets section. This is our assets section. The total assets figure is the one that we just used now, right? The 3.517 when rounded up. And the total liabilities, we also get it again from our, I don't know where I've placed my paper. Okay, but we'll just get it from the balance sheet liabilities and equity section that we looked at earlier on. Now, let's not worry about that. I think it's down here. Okay, there we are. Right. Total liabilities and equity. Total equity. So we said total liabilities, right? We look at our total liabilities. This is liabilities section. Where is our liabilities? Okay. Total equity is this one. Okay. Long-term debt, this one. Okay. Right. If we add these two, okay, they will give us our total liabilities. Current liabilities plus the long-term debt, they will give us our total liabilities. Okay. Okay. Here are the figures, right? So we have got this one. That is the 1040, right? Rounded up to the nearest 1,000. We'll get 1.40 plus the long-term debt 500,000, right? Which is the 500 divided by the what? The total assets figure, which is 3.517, and it will give us 43.8. Again, that won't make sense to us for the time being unless we compare it with the industry averages. How do we do that? Let's have a look at the situation. There we are. The industry average stands at 50%, okay? And that industry average compared to our 2015 performance, we stood at 54.8%. What does the 50% industry average mean? It means the rest of our players in the same industry are maintaining their liabilities at half the worth of their assets. But we are slightly above. We were slightly above in 2015, but it's not really bad, because you see we are only above the industry average by 4.8% there. Okay, here. This is just 4.8% above this, so it's closer to there, somewhere there. Then we go to 2016. 2016, my God, 80.7, a staggering 80.7%. It means we had so many liabilities compared to the industry. It means we are financed mostly through borrowed funds. We are surviving on borrowed robes. That's bad. Such a situation is not really good. We should strive to go. So what does that mean? We must take action when that is the case. When we are more into liabilities, the owners of the business should inject funds. Instead of declaring dividends year in, year out, they should retain their earnings in the business so that the capital, right? The capital increases. Remember, our formula that we looked at is below is the total assets. And in the total assets, right, we need to capitalize more. If we give more capital, which may be in the bank as cash, then it means our denominator will increase. And when it increases, the numerator becomes proportionally smaller, and our debt management ratio goes down. Projection in 2017, we sit at 43.8, below average. It means we have got lesser liabilities compared to our assets when you compare it with the industry averages. Good, it seems, but is it good? It may be good, it may be bad. Because in business, the easiest way, the cheapest way of financing an organization is to finance it through borrowed funds. Why? It may look absurd, but that is the fact. Because borrowed funds, you can just start a business with nothing. You go and borrow, you make money, you return to Caesar what belongs to Caesar, and you remain with the profit. That's how it's good. Also, borrowed funds, you are exempt from payment of taxes. There is a tax exemption or a tax saving associated with the payment of interest on borrowed funds. Ladies and gentlemen, I hope this is enough for now. Until next time, goodbye.